So I'll start by introducing myself a little bit, and since we got a small group, I'd like to hear what each of you do, so might help stir some stuff up. I grew up in a little town in Huron, Illinois, about 600, population of 600 people, so pretty unique situation. My dad used to have a funny file, so this was before emails, right? And it had things about living in a small town, like you dial the wrong phone number and talk for 10 minutes anyway, or nobody uses their blinker because everybody knows where you're going. So my family owned a wholesale fuel and lubricants business, so we delivered to farmers, excavators, trucking companies, manufacturing, so we delivered the fuel. We didn't have C-stores and stuff like that, so grew up in that company. Worked away from the business for a while, came back in 1991 and more or less took it over. While I owned it, had the opportunity to purchase 11 other companies. So grew the company from $750,000 a year to over $42 million. Sold my company, sold my company in 2010 to Growmark, which is a $6 billion agronomy company. And did banking for a little bit, and then got into, started Innovative, got my entrepreneurial itch back a little bit. So at Innovative Business Advisors, we do three things. We help people buy and sell companies. I'm a CVA, a Certified Valuation Analyst. So we do a lot of business valuations, which we'll do at the end here. And we also do coaching and mentoring and stuff like that. So this is going to be very open. We're scheduled for 2 hours. I think I've got more than enough information, so if we get to the end of 2 hours and you want to stick around and ask me some questions, you're more than welcome. And feel free to ask questions at any time. So Alan, you shared with us that you have a body shop?
In O'Fallon, Missouri. That's where I was born and raised, and been there a few months away from 30 years in business. 14 years for other shops, and my dad had a business growing up. I worked in there, and it's about time to...
So you started with the Model T and went all the way up, right?
It seems like it.
Maggie, you're with the Department of Veteran Affairs?
No, we're a separate nonprofit, not related to the VA at all.
Okay, I'm sorry.
So we're the Veterans Business Resource Center.
Gotcha.
And we work with the SBA as a resource partner with SCORE, and we act as the Veterans Business Outreach Center for Missouri, Kansas, Iowa, and Nebraska for the SBA's office. We help veterans and or their families start and grow small businesses. In the office, I mainly work with our training program and the clients we get that are early stage, low-level planning done for businesses. We have another consultant in the office who works with those who are in advanced stage or in business. Actually, he does a lot of valuation himself for helping those.
Good. Well, let's see if I'm doing it right?
He's got 20-something years experience in the industry before coming to work for us.
Well, good. Well, it's kind of neat. I had a client that I do coaching with, and I'm telling him all this stuff, and last month he comes back. They come to me for their coaching thing. It's him and his wife, and he's like, I went to the seminar in Nashville, and oh my God, they talked about cash flow. It's like, what do you think I've been telling you for the last year? He goes, well, I know the whole time I'm sitting there and I'm thinking, this is exactly what Terry's been telling me. It's like, yeah. Greg, how about you?
About 35 years doing tax and bookwork.
That's right, okay.
Mainly taxes. I've got about 20 little companies I've helped, not financially, but it helped set up about 10 or so little corner bars that don't exist anymore.
Okay.
For some reason or another.
Cool. Well, hopefully you'll get some stuff out of this. Bob, you're with SCORE.
With SCORE, I've been, as of Wednesday, 13 years with SCORE. And part of that, I was an investment advisor for 13 or 14 years in there, and I just retired at the end of this year. And it's interesting because people say they don't hear you all the time when you say what you need to do, and then somebody else tells them, they go like, yeah, that's what I've been saying for years or whatever.
Well, good.
But prior to that, I had a 28-year career in the retail optical business and ran divisional vice president, ran a couple hundred optical stores across the country, and traveled a lot.
I'm going to get my eyes checked on Monday, and I know my optometrist is going to laugh at me because a year and a half when I was there, and he said, "Do you want bifocals with your glasses?" And I'm like, "No, I'm not getting bifocals." He's like, "All right, I'll see you in a year and a half." Well, guess what I'm going back for Monday.
Well, it's the thing is, it's a fact of life. Usually around in the mid-40s, you ask that, that you start losing your zoom.
Mm-hmm.
Actually, it started when you were about 12. But when you lose it from here to here, nobody cares.
Yeah.
And when you lose from here to here, it's when it all of a sudden gets out here, you say, oh.
This ain't working. Jason, how about you?
I'm a commercial lender with the Bank of Franklin County.
Okay.
Work out of our O'Fallon office. We're
O'Fallon, Missouri.
Yeah, what's that?
O'Fallon, Missouri.
O'Fallon, Missouri. We're headquartered out of Washington, Missouri. We have 5 locations now, O'Fallon being our 5th one. I've been with the bank going on 2 years, been commercial banking for 14. What we pretty much do there is work with independent, privately held companies, family-owned businesses, second, third generation. We help them with obtaining necessary capital to maintain and grow the business. Structured buyouts,
Cool.
equipment financing.
We may want to talk to Maggie before it's over so you can help her with some SBA loans.
Yeah.
Well, great to have you. Thanks for coming. How about you, ma'am?
So I'm Joy Bridges. I apologize for being late with you guys, but I have a virtual accounting and bookkeeping business, Harmony Accounting and Bookkeeping. It is virtual, but I'm based in Atlanta. I literally just got off of a plane.
Oh, wow.
So, no time to change, but yeah, I help small businesses get their bookkeeping cleaned up. I also have ongoing clients. It really just depends on the other business owner's needs.
Cool. Fantastic. All right, we got a great group of people. Fun. Okay, so the presentation's about what's it really worth. We're going to start off talking about normalizing financial statements and how to come up with a value of the company. I'm going to talk about how is it a bankable deal, especially it seems like we're all dealing with kind of smaller companies and not, publicly traded companies. And then I got a cash flow game that we'll play. It makes it a visual for accounts receivable days, payable days, inventory days, stuff like that. That's kind of fun. And then if we still got time, I'll go over an actual valuation. And then some of the things that I got on your table, we'll talk about some non-financial things that can really affect the value of a company. So we talked about what Innovative does. So valuing a business, is it an art or a science? We gave a valuation this morning, and the market data. This was a diesel repair shop. We hang our hat on the income approach, but we also look at rule of thumb data that shows market transactions that have happened. And in this particular case, they was both very close. Sometimes you get quite the disparity, and so there's judgment calls into it, and that's really what comes with the non-financial factors that we'll talk about a little bit later. So today's objective is give a reasonable understanding of how to value a business, to give you an idea of non-financial things that an acquirer may look for in your business, and how does my company look if I wanted to sell it. So I said, how does my company look? So what I want you to do is I want you all to think as if you're business owners today, okay? And we're thinking about your company. So today's story is we're going to assume that you own 2 diesel repair shops, 30 miles apart, so you got 2 shops, and you've learned that acquisitions is a great way to grow. And add trained people to your team. So now you're beginning to view opportunities that have come your way. So maybe you hired a broker or whatever, but you're starting to see some things come to your plate. So what I want to tell you, and I promise I'll quit reading slides to you because that drives me crazy, but in the world of valuation, this is kind of a big thing. It's the IRS Revenue Ruling 59-60. So I promise I won't read it to you, but basically what it means is your company is worth whatever you're willing to sell it for and whatever somebody else is willing to buy it. So we go back to the art and the science. So it's like everything we're going to talk about today doesn't really matter. What it's really worth, the fair market value of it, is what somebody else is willing to pay for it, and you're willing to sell it. So that's at the beginning of pretty much every valuation that you see. So in front of you, you have 3 financial statements of companies that have come to you that you're going to look at and think about buying. The first thing we do as valuators is we want to get to seller's discretionary earnings, or SDE. So think of seller's discretionary earnings as all of the income coming into the company that the seller has the discretion of spending, whether it's on a salary, whether it's to pay bank debt or pay for a lake house, whatever he chooses. From that, we want to subtract a fair market salary and get to the EBITDA of the company. So you subtract the fair market salary from seller's discretionary earnings, and that gives you EBITDA. So EBITDA is earnings before interest, taxes, depreciation, and amortization. That's the true cash flow, okay? Alan, I get a feeling that you may not 100% be like the main financial guy, so if some of the things that I'm saying
You're right.
are going over your head, stop me, okay?
I read all of this, but
Okay.
I
So, because this is important for you, and I want to make sure you understand it. These guys seem like they have a little bit more acumen with financial statements. Don't ask me to take a dent out of a car, so don't feel belittled about it. It's just the nature of what we do. So, this gets small. That's why I gave you a printed copy. So what I want you to do is we're looking at 3 financial statements. They've all got the same top line revenue. They all got the same gross profit. And you see quite a bit of difference in net income. So at first blush, you might say, if you have company 1 that shows net income of $328,000, company 2 shows a net income of 0, and company 3 shows negative net income of $141,000. I think that's what I got, yes. Which one would you want to buy? Joey, you said company 1?
Absolutely.
All right. So now we need to go through the process of normalizing that financial statement. So go down the line and look at those expenses, and if we're going to add back the owner's salary, we want to add back things like depreciation and amortization because those are non-cash expenses. Meaning, you buy a piece of equipment, and when you depreciate it off down to a lower value, you're writing some of that off every year, right? So we want to add that back. Look and see if you see any personal items that may need to get added back into cash flow. And if you want, I'm not going to make you do a bunch of math or anything, but just kind of put a check mark in them, like, Alan, I'll see. So here's your office salary, so that's something you may want to look at. There's amortization, depreciation. What do we got? Lake house for supplies. That might be something. Officer's retirement plan. Well, that's probably for the owner. So things that you're really looking for are expenses that won't be there for the new buyer. That are going to go away, okay?
Hey, can you actually do that? Lake house supplies. I remember years ago, I bought my wife a new car, and every 2 years, and I mean they're taking, like I always tease my wife, hey, we talked about buying a frame rack at dinner tonight, so right up you can't.
Yeah. So here's what I would tell you. I am a big advocate of a couple of things. One, it's not about sales and net income. It's about gross profit and cash flow. Okay, and we'll get into that deeper in a second. 2, I'm all about building your team. So I'm not the person to ask that question. I would tell you as a business owner and formerly owned a big business, I'd run as much through it as you can. But the person you need to consult is the guy that's doing your taxes and say, what can I get away with here? I mean, I've had lots of conversations with my CPA in buying different companies and selling my company. It's like, he goes, I want to protect you if you get audited.
Exactly.
So let's push it to the limit, so to say, and then from there you make a judgment call if you want to push it further. But if we're going to go to audit, we don't want to get in trouble with the government.
A friend of mine who's a CPA, a former IRS agent, he says the question is not, can I deduct this, but how can I deduct?
That's a good point. I like that.
Well, you know, it's, the thing is, I would tell people that, you know, sometimes, and I'm not being a CPA, obviously, but to say is, you know, I used to go on vacations, now I go on business trips to nice places.
That's right. Okay, so you've identified some things that might get added back into cash flow. Well, this is what's very interesting. So as you can see, the one company, the owner of the company wasn't paying himself anything. In the second company, I would call $100,000 a fair market salary. So we had that back. The other company, that guy was paying himself $325,000 a year. Those are things we quite often see. Amortization and depreciation we talked about, non-cash expenses. The lake house, that's something that the new owner isn't going to get. And then officer retirement and cell phones. Those are all personal items that this gentleman or person is running through the company that the new owner wouldn't have, right? But then at the end of the day, look what we got. You got the exact same cash flow for all three companies. So that's what can be a real eye-opener. You get people come to you, Jason, you've probably seen it 100 times, right? They're kind of handing you their financial statements like, man, these are ugly. I don't make a lot of money. It's like, yeah, but you got $250,000 of depreciation, you know, that get added back in. So that's what we're getting to, the true cash flow of the company. So that seller's discretionary earnings, what I talked to you about, minus a fair market salary gets you to EBITDA, or the true cash flow of the company, and that's what we're going to value, okay? And that's what I just said. So there's three approaches to value a company. The income approach, and really this is no different than real estate. The income approach, we're valuing the income of the property. The market approach, most often used in real estate. So if you have a 1,500 square foot home on this side, you know, 3 bedrooms, 2-car garage, and it sells for $150,000, and there's one exactly like it across the street, it's probably worth $150,000, right? So it's a little bit harder with businesses to do the market approach because each business is kind of unique to itself. Now, that being said, you happen to be in a segment in an industry with auto body where, yeah, they may be a little bit different, but in general, they're the same. And if you think of dental practices and, you know, certain things, there is some commonality to it. So if somebody's recording, you know, the sale of these companies, we can probably come up with some fairly, at least a close range of what a multiple might be that it's selling for in the market. So, okay?
Yes.
And then the asset approach is typically used when the company's not making any money, or the market value of the equipment the company owns is greater than the value of the cash flow coming off the business. So that's a question that I get asked a lot, and it came up this morning in a valuation that we presented. So what about my equipment? Well, the way we look at equipment in evaluation is you've purchased equipment, and I'm not talking about your real estate or your building, your equipment. You've purchased equipment to generate cash flow. That cash flow has a value. If the value of that cash flow is greater than the market value of your assets, not what they are on your balance sheet so necessarily, but the cash flow, the value of the cash flow is greater than the market value of your assets, you have goodwill in the company, okay? So if the value of the cash flow the company is generating is worth less than the market value of the assets that you've purchased to create it, you really don't have no value in the business. You have an asset sale. You're going to sell your assets and get rid of it. So you see this a lot. I don't know, one that comes to my mind, maybe it's because I was in the fuel business and we delivered to a lot of excavating companies, but you know, think of an excavating company, they got all these big tractors and land movers and stuff like that. That's all expensive equipment. And if that excavator isn't making a lot of money, it's quite possible that the value of those assets are greater than the cash flow is generating, okay? So those are our three approaches. Under each approach, there's a different methods. So a very common method of valuation under the income approach is a discounted cash flow method. And this is kind of a simple one that I hope will help you wrap your mind around it. Most of the companies that I bought in most of the companies we sell, especially, you know, in that $1 to $15 million range and lower, will sell at a price where it can pay for itself in 3 to 5 years. It's a good trigger point. So what the discounted cash flow approach is all about is what rate of return do I need to make it worthwhile for me to buy this small business? You know, if I wanted to buy something safe, maybe I'd go buy Ford stock. It's got its ups and downs, but it's a big company, right? So if I want to pay for this company in 3 to 5 years, then I need a rate of return of 33% for 3 years, 25% for 4 years, and 20% for 5 years. Make sense? So what we're doing in a discounted cash flow is we're coming up with what percent makes sense and dividing it by that cash flow. The EBITDA, that was the, remember the 300,000, that was our EBITDA number. So if I divide 300,000 by 33%, you come up with a value of 909,000. Likewise, 25% 1.2 million, 20% 1.5. Pretty simple, right? We learned all this in less than a half an hour. So what do you do next to say, all right, you know, now we have a value range of between 900,000 and 1.5 million, but how do I know, is that, you know, is that a good number? Well, I found out last week, we actually trademarked a term, and I haven't updated my slide deck yet, but we have a trademark on the term bankability measure. So one of the things that I really hang my hat on valuations, especially of smaller companies, or really with companies that have cash flow of less than $1 million, is it a bankable deal? So if we say this company is worth $900,000, can I go to Jason, put down a reasonable down payment, and have enough cash flow from the company to pay for itself in 5 years? Would you appreciate that, Jason? And that's a good indicator, and we'll show you in a minute here, hopefully I get this part to work, of our what we call the bankability. And I wanted to make this bigger, and it's not showing me how. This is where I kind of need Steve's help. Whoa. Okay, well, can you guys see this, or is it just completely too small? It's pretty small. Zoom in. Okay, well, that doesn't really help us, does it? Now I got to get it to zoom out. Okay, well, let me go through this. I apologize that that's not bigger. What we're saying here is there's an estimated selling price of this company of $950,000. And we're saying that a reasonable manager's salary is $100,000. And outside of an SBA loan, a bank would like to see, it would be normal for them to ask for a 20% down payment, correct? So if we put a 20% down payment of $190,000 off that $950, that's a 20% down payment. It leaves you with a loan of $760,000. I got a 5% interest rate in there in a 5-year term. So, and so we're going to pay that off in 5 years. Under that scenario, you're going to have debt service of $172,000 a year, which leaves you excess cash from that of $128,000, and that's going to give you a debt service coverage ratio of 1.74. Now, what does that mean? That means you have $1.74 in income coming in for every dollar's worth of debt. Okay? Now, typically, a bank's minimum debt service coverage ratio is around 1.2, correct? 1.25 in that ballpark. But
yeah, 1.2 is probably standard.
Yeah, but if I came to you with a deal where the cash flow is 1.74, I'm probably going to smile, right? That's, yes. So he said it best. He's licking his chops. That's a good bankable deal. So, and the point is that you can pay it off in 5 years. Now, you can go get an SBA loan and maybe get 10 years. And if we stretch this out to 10 years, oh, good. This will let me. Look what happens to our debt service coverage ratio. Is that better? It jumps to 3.01. Now he's really happy. But here's what I want to caution you of, and where I really think, especially for you people that advise people, to think about. I think, not Jason of course, but some banks are guilty of selling loans. So if we have a debt coverage ratio of 3.1, that's fantastic, right? Way high. But here's what happens sometimes. They'll say, what if I value this company at $2 million? Now we're at 1.47, so let's say 1,800,000. Okay, we want to go a little lower. It's not 17 million. Hi there, welcome. Dave, I presume, is that right? Dave Weaver, nice to meet you. So here we go. Now if I spread that amortization out to 10 years, I could increase the value of my company to 1.7 million, correct? We got great cash flow. Banker's gonna like it. But I would argue, do you really want to be paying for this company for 10 years? And I'll spend the rest of the day arguing that no, you don't. It's too long. What I do tell people all the time is there's nothing in my mind wrong with taking that 10-year amortization because you can still prepay it, right? And a lot of times, especially if they're first-time buyers, like your situation, take the lower payment, build up your cash reserves, have a safety fund there, and then start chomping away at that debt. Okay? So we know that 1.7 million is too high. And we want to purchase a company 5 years. So in my valuation process, so we're ending up with a cap rate here of 31.5%. So that's the rate of return we're getting on our money. So we're going to pay this thing off in this scenario in a little less than 3 years. That's probably a pretty good deal, and it's bankable. I like it. If I was valuing this company, that's probably where I would settle. When we go through the market data, I don't think I put a whole lot of market data in here. I may get a range of say 600,000 to 1.2. So usually in a valuation, if I'm doing the same scenario, let's look at what 1.2 million looks like. Gosh, Dixie. We're getting a debt service coverage ratio of 1.38. Well, still passes for the bank, but I'm part of the issue, and it really kind of delves a little too deep to what I want to go today, is more than likely on a loan scenario like this, when you make a loan payment, you're paying principal and interest, right? Principal, you can argue, is a cash expense that doesn't show up on your income statement. So you're paying that principal amount out, but it's just coming off your balance sheet, right, Joy? And what'll get people in trouble in a scenario like this is the principal payments are greater than this excess cash of $82,000. So all of a sudden they get behind, and that's why. And a lot of people don't pay attention to that. So that's why I know if I'm at 1.74, 1.8, the excess cash right there is going to be greater than those principal payments, and that thing will cash flow a lot better. Does that make sense, Dave? Alan?
Yeah.
Sorry. Okay. So, but then let's go look at the other end. I said, say, if a market approach gave us that a value through a market approach is 600,000, and I got a debt service coverage ratio of 2.76, I know I got room to go up with that valuation. Make sense? Have you absorbed that? Because this is a kind of an important piece. I want to make sure you understand that. So I often use this in price negotiation. There's a little bit, again, art, science, strategy. How do you want to go about it? If I'm representing the buyer and the owner wants that 1.2 million, I'm more than comfortable to sit down with that owner and say, it's too high. It's not a bankable deal. I can't go to Jason and make this work. We play intermediary a lot. I got a valuation we're going to be doing for an auto body shop, believe it or not. And they're paying me to do a valuation because the seller wants to sell to these guys and the buyer wants to buy. They have no idea what it's worth. So I'm going to go through a process like this for them to establish a price. Now, the one thing I want to add to this also is this is a financial valuation. Now remember, you're a business owner, you're thinking about this, right? You own 2 shops. What if there's one in the middle? So I had a scenario when I owned my oil company that I had 2 shops, then that's kind of where the scenario came from. I had 2 offices, bulk plants, bulk storage facilities, 30 miles apart. The guy in the middle of me was an old Whamco jobber, and he wanted to sell. And he wanted about $100,000 too much for his business. But in this area, I had a huge amount of customer concentration. And the last thing I wanted was for a competitor to come in and buy that location. Now, that's like putting a cancer cell right in the middle of an area where I do a lot of business. So, did I pay him $100,000 more than what the company was probably worth? You bet your booty I did. And I tore down his bulk plant and nobody ever built another one, and I got his customers and I just secured a bigger area for me. But now, here's something to think about. And this is something that my CPA used to beat me up on. What are we valuing right here? We're valuing the existing cash flow of this company. So if this is a strategic valuation, what might we want to do? Let's go back down this list and see what operating expenses are on there that I'm not going to have when I buy that company. So in my particular case, with this guy, he was a one-man operation. I got 2 bulk plants, or 30 miles apart. He's in the middle. I'm not going to have to pick up a driver. I mean, I'm driving past his customers every day anyway. So in essence, for me, what I'm looking at is that $700,000 of gross profit. I might pick up a little bit more postage. My people in the office might have to work a little bit more because we just added 250 accounts. But by and large, I'm probably getting rid of 70-80% of his operating expenses. So now, if you're valuing the cash flow for what's going to come to you, all of a sudden that's a whole nother scenario, isn't it? So when Growmark bought my company, and Growmark's a $6 billion company, they have their own acquisitions department. I mean, they got a whole group of people. That's all they do is buy companies. And I got to know them pretty good. And because I pretty much facilitated my own deal because I'd purchased 11 other companies. I mean, from the time we signed the letter of intent till we closed, it was 6 weeks. It's a lot of attorney's work to get through in 6 weeks. My purchase agreement was about this high. So Dave's an attorney that does M&A transactions. So, but we got that done in 6 weeks. And the only reason we got it done is because I would say, I was more of a sophisticated seller. And they was definitely a sophisticated buyer with their own in-house attorneys and stuff like that. But I asked her at the end, I said, what's your trigger point? So I told you, for me, it was 3 to 5 years of the existing company's cash flow, and that was my trigger. And she said, what's your trigger? Bam, 33%. It's like, wow. You're going to take, because the cash flow you're getting from my operation ain't going to pay for what I'm getting, 33%. But they do look at it different. They look at what is the cash flow of that company going to be after we purchase it. So Growmark's an agronomy company with an energy vision, but they're pipeline shippers. So they buy their own fuel on the pipeline. So that's going to decrease their cost of goods sold section. So they're going to be able to generate more gross profit than what I did. And I operated 100% inside of the territory where they already had existing facilities. So, how many of my operating expenses are they whacking away? So that's the way they looked at it. They did read. So, what I told you to look at the value of the cash flow, the existing cash flow of the company, it's not, back to the art and science thing, it's not the only way to do it. And Growmark definitely does look at it the other way. So Growmark ended up buying my lubricants division, and 8 of their FS member companies bought my fuel division. So it actually got sold to like 9 different companies. So it was interesting. Okay, now if I do this right, I should be able to get out of this. Yay, all right. Now, what outside factors can affect the value of the company? So go to this is what we're going to go to next if you want to look at this next page in your packet. There's definitely non-financial things that will affect the value of your company. And when you leave, if you grab this flyer right here, It'll direct you to our website, and you can take this value builder questionnaire, and I would be happy to go over that with you. There's also a thing on there called pre-score. So that's for the business owner, like you, Alan. That is good questions for you to ask personally, that asks you personal questions. Are you ready to sell your business? Because I can tell you, when I sold my business, I had no idea what I was going to do with the rest of my life. So that's what the last chapter of my book's about. So let's get into that. Now, I'm not worried about this being small because you got it in front of you. So remember our scenario. You're a business owner. You're looking at buying a company. You've got 3 opportunities in front of you, and you're trying to weigh it out. We know that the cash flow from each company is the same, right? So which one do we buy? So think about this. So recurring revenue. I can tell you that companies that have recurring revenue will definitely sell for a higher price than companies that do not. So think of my innovative business brokerage group. If I sell a company, now I got to go find another company to sell. You know, if you're a contractor and you build a house or you build a building, when you're done, what do you got to do? You got to go find another building to build. If you're an HVAC person that does repair work, you know, the air conditioner is always going to break. Probably going through it right now with a lot of HVAC guys. Turn the air conditioner on for the first time in the year, it doesn't work. So that's recurring revenue. You know, dental practices, insurance companies. Great recurring revenue. Banks to a certain extent. Great recurring revenue. My oil company, we sold fuel to farmers, municipalities. So farmers are going to farm every year. Haven't seen a year where they just said, yeah, I don't think I'll do it this year. You know, municipalities, the ambulances and the cop cars and fire trucks, they're all going to run. So that's what you think about for recurring revenue. When we do a market approach on companies with like insurance that have high recurring revenue, that's where oftentimes that market approach is going to be a much higher than what we come with an income approach. Does that make sense? So in our scenario, company 1 does annual preventive maintenance on diesel trucks for all customers. For all their customers, so these are people that are coming in every year, right? You got to have annual inspections, stuff like that. It's about an average ticket of $1,500, and they got 400 clients that they do this for. If you look off to the side of this, there's a plus and a minus. So as I give you the scenarios for each one of these, you may want to put, you know, which company would you want to buy, 1, 2, or 3. Opportunity number 2, their main business is 2 local trucking companies that have about 10 trucks each. They all do. They do all the work for those 2 companies. The rest of the customers come to the shop on an as-needed basis. So there's no reason to pull them in on a regular basis. Company 3 is next to the interstate. Mainly people coming off the interstate, not very many local customers at all. Okay, so kind of jot down in your mind. And I printed what I'm reading off to you, so if you need to go back later and make a decision or you change your mind, you got something to reference to. So what's monopoly control in the value builder system? The monopoly control is insinuating that you have a say in setting your price. Probably the best example of this is look at C-stores. You know, you get off of 170 down here into Quick Trip, and they got their price posted on the street, right? Well, I think they was $269 today when we came in. Well, if there's one across the street, or even when I was driving in, you know, other people do the same thing. Craziest concept I've ever seen in my life. You know, I'm gonna put my price out there. You know, bank don't put their interest rate on the board, right? So, you know, but, you know, Alan, maybe you're in a business, you know, you're fixing cars. We have for sale a restoration business right now for cars. So if you're the only restoration business in town, you probably got much easier at setting your own price, right? Yes. Versus if you've got 6 auto body shops in the same town, you're probably going to be held a little bit closer to the pin, right? Yeah. So in scenario 1, you're the only shop in town, and there's no pressure on shop rates. Opportunity number 2 has to match a shop rate of another competitor who's 30 miles away. In opportunity number 3, there's 4 other shops in 10 miles, and there's a constant war on rates. I'm going to shut this if you guys don't mind. So we'll keep We'll keep going. If I'm going too fast or you want to stop me, please feel free. Customer satisfaction. Do you survey your customers? You know, this is, maybe wasn't such a deal in the old days, but now with social media, geez, how are you rated on Google and all the other sites? So, opportunity number one, these are what you'd be due diligence questions. So while you're going through to buy a company, think about this as questions you want to ask that other business owner. Because if it's bad, they ain't going to tell you, so you're going to have to drag it out of them. Opportunity number one, doesn't know, has never done any customer satisfaction surveys, old school, right? Opportunity number two, most of his new customers come by word of mouth. Pretty good scenario. Opportunity number three, ask for reviews on social media and has a 5-star rating on most sites. You do customer surveys, Alan?
Pardon me?
Do you do customer surveys?
No, insurance companies do it for you. That's how you get direct repairs.
Yeah.
And I was just thinking about this lady. Pete went out to look at her car, and she's sitting down, and my wife's behind the desk, and she goes, "Yeah, I just wanted to tell you something. I put it out there. I need a body shop. I've never been in an accident." And she goes, in less than 15 minutes, 22 people, all 22 was our name, button on about it. And I was just thinking about Zillow. You guys heard of Zillow? We got a call. Connie goes, "We're not gonna, I don't know if you call it join or be a member." Boom, man. Nasty ass comment on Zillow.
Mm-hmm.
And
it's frustrating, and there's nothing you can do about it, right?
Yeah.
There is actually.
Boy,
I can introduce you to a company that you'll get to monitor those bad comments before they're posted on your site.
yeah.
So,
But my wife doesn't want to be. We had a customer put us on Facebook, fix his truck, and like, dude, that was a 2018, and it was a $19,000 accident. You don't want to broadcast that, but he did. And, because who wants to buy that truck?
yeah, that's
but
funny.
it's nice.
I had a local race car driver. You said you use race cars, didn't you? Or motorcycles. But he was doing like raising money for breast cancer or something like that. So a whole bunch of people bought his shirts, and he posted a copy of the check that he was of his personal check that he was donating to the fund. And I didn't even know the guy, but I called him. I had his cell phone number for some reason. Maybe it was on the check. I called him. I'm like, dude, you just put your checking account number and routing number for all the world to see. What are you thinking? You might want to go to the bank and close that account. Here's your sign, right? Okay, hub and spoke. What's a hub and spoke? Alan, this is one you probably need to pay attention to. I don't know for sure, but I'm thinking. So hub and spoke is basically, are you the hub of your company? And the spokes are all your customers, your suppliers, your employees, are they all coming to you? If I take you out of that company, is it going to run? And that's tough, especially for smaller businesses. I was fortunate as I grew my company. I had 3 operations managers and an office manager. They preferred it if I wasn't there, and they did just fine. I'd go on a 2-week vacation, come back, answer a couple phone calls, and giddy up. So, I'm guessing if you're gone for 2 weeks, that might be a problem. Yeah, so in our scenarios, owner 1 performs 30% of the work, and the customers love him. Opportunity number 2, the owner leads business development for the company. He has a shop manager and office manager that are primarily doing the work. Opportunity number 3, the owner has a monthly meeting with his managers, but otherwise he's not seen by the employees or the customers. So if you're coming to buy that company, what's the best scenario? And
Free without a doubt.
yeah, so I had a company, true story, that we was trying to sell. It was a trucking company. He did trucking and logistics for in the St. Louis area for construction sites. Dude was making $500,000 a year in cash flow. I mean, that'll attract some buyers. And I had people from other states interested in buying this company. But it never sold. You know why? The owner did everything. He brokered the trucks. The employees came straight to him. All the customers came straight to him. I mean, it just made it an unsellable company.
talked to a woman that had a nice company that did a lot of design work and stuff, kind of architectural type of design or whatever. And I said, are you a business owner or are you self-employed? She says, well, I have 12 employees, I must be a business owner. I said, that isn't the test.
Yeah.
I said, if you do Bob's Hawaii test, you go to Hawaii for a month, sit on the beach, no phones, no fax, no communication with your company. What do you find when you get back?
Yep.
She goes, oh my God.
Yep, you're exactly right. So I had this particular customer or person was a customer of mine with the oil company, and then I worked at Regions Bank for a while, and that's a very common theme, isn't it? Ted, edit that out. But anyway, Mom died. Mom was a patriarch of the family. Guess what? No estate planning. It was a disaster. Huge tax bill, you know, things to work out. The son and the dad was just as old. You know, he can't hardly climb up into a loader anymore. And this is a pretty big trucking company. I would say, again, they're probably running 50 trucks. You know, one of these deals, he's constantly on the phone. You can't sit down and have a conversation with him because his phone's just ringing off the hook. And I have known him for over 20 years. And I said, you need to find a dispatcher and you need to run this company. And he looked me straight in the face and he said, Terry, I'm the only one that can do this job. And it's sad. Yeah, ouch, right? So I can't emphasize enough, these non-financial things, you know, can really kill a company if you don't have this right. Growth potential, another thing. Opportunity, you know, can you grow this company? Is it repeatable? I have a friend who owns a cell business, sells phones. She's got 20 stores just in one state, but she can duplicate that process really easy. It's kind of a nice thing about franchise. So in your opportunity number one, the shop is too small. It's located in a town between your two current shops. What scenario did we hear about that? You know. Opportunity number two, the shop is of adequate size and has a long-term lease associated with it. And opportunity number three, uses about 75% of the building. It's a high traffic area, 50 miles from your home in the opposite direction of the other shops, and the real estate is available with the deal and it's at a fair price. So which one do you like there? Switzerland structure. We've got two more to go through, so I don't want you to think that this is going to last for another hour. Switzerland structure. So Switzerland was a very independent country, right? Didn't fight in either one of the world wars, and you know, just you guys go do your thing. I'm over here, right? So, kind of along with the hub and spoke, is your company independent of any one employee, any one customer, or any one supplier? Insurance companies can be a good one. Even banking, you know, do you have, you know, is your insurance practice just, I got 1,000 customers and none of them amount for more than 2% of my business, you know? The one example I love to use on this one is another trucking company. Imagine I'd like to know how many fuel trucks were running our fuel on the road at one time. It's amazing. But this customer, again, about 50 trucks, going through about 10,000 gallons of fuel a week. So big customer of mine, and he is still working. He's in O'Fallon, Illinois. He hauls all of the milk out of Dean's Dairy in O'Fallon. And so you'll see his trucks all around town. You see big Dean's Dairy on the side of the truck. It all comes out of O'Fallon, Illinois. Guess how many customers he has? One.
Oh, boy.
This is a pretty big operation. He has one customer. Would you want to buy that company?
I had a store client the same way. He said, I want to retire in about 5 years. And one of his issues was he had one customer that was 90% of his business.
Yep.
And I said, tell me about that customer. Well, it's a good friend of his, and we've been doing business for 20 years. Now, if you weren't there, could he get the same thing somewhere else for the same price or better price? He goes, Oh, certainly.
Yeah.
What do you have to sell?
What other nail you want to drive in the coffin, right? I got burnt on this. I bought a company, Thomas Oil Company out of Wood River, Illinois. And so I was a fuel company that sold lubricants, but we mainly sold diesel fuel. Thomas Oil Company was a lubricants company that sold fuel. So I needed his facility for a growing lubricants business. I had trademarked my own brand of lubricants as much as anything. Well, he had a customer concentration issue. And not huge, but maybe about 30% of the lubes he was selling went to a mine in Carrollton, Illinois. And it was high margin business. All this stuff's got to be repackaged into metal containers so it can go underground. And mine's been there a long time. It ain't ever gonna close, right? Well, guess what? 2 years after I bought it, it closed. Well, so for me, it was kind of a situation, well, that really sucked, but I needed his facilities anyway, so it still wasn't that bad of a deal, but it was painful. Another one to think about this, though, is what if you have a branded contract? So with me, I had a lubricants packaging contract with mobile distributing, so repackaging contract. So I bought everything in 8,000 gallons at a time. We filled buckets, 55-gallon drums, reloaded it onto our trucks, and I had a license with them to do that. Just because I'm selling my company doesn't mean that the buyer gets that license. So, and they didn't. So when Growmark bought my business, Mobile didn't give them that contract. They're competitors all over, several states, but they didn't need it. They blended their own lubricants. So, but that could have been a huge issue if you want to buy my company, but you got to have that contract or you're not going to buy it. Just another quick story, true story. We sold a environmental drilling company. This husband and wife started from scratch. They got 15 employees. They're running about 4 drill rigs. They've done a great job with the hub and spoke. They got 2 guys in the office that do all the bidding, can run it. He's a Corvette guy. They go on vacations. He comes back. Everything's running fine. But never put any golden handcuffs on those 2 employees. So now our buyer was a young couple. He's got an MBA, engineering degree, perfect to buy the business. Grandpa sold his business, giving him the money to buy this business, so it all fits. But guess what? He don't know anything about the drilling business. So he has to have those 2 key employees. Well, 2 weeks before we close, we're spending a lot of money with 2 attorneys in the room, the sellers, and debating, are we going to make these 2 guys sign a non-compete, an employment agreement? Or are we just going to go in and say, hey, everything's going to be hunky-dory, we're going to put in a profit-sharing plan and run with it? And there was a lot of debate. And I was actually getting my Value Builder certification while this is going on, and there's about 50 of us in the room, and I said, what would you do? Then about half the room raised their hand, said, you got to make them sign an agreement. There's no way I would buy this company. And the other half said, I don't know, if they don't have one now, So what we ended up doing is we didn't have them sign an agreement because, they're blue collar workers. They've never signed an agreement before, and we was really afraid that we'd scare them off. And there was some hiccups. It didn't all go smoothly. One thought they should have been offered, a shot at it and blah, 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 but it worked.
Would you have considered a consulting agreement along with the non-compete?
That's another way to do it.
Agreement for 3 years or something like that?
You mean for the former owner, or?
For the 2 guys that you were saying that were critical or whatever. That you wanted to have the non-compete.
Yeah. I mean, if we was gonna make them sign an employment agreement, then the plan was to give them $10,000. So pay them for it.
Yeah, you gotta give them something or guarantee them.
Yeah.
Guarantee that they're gonna have a job.
Yeah, but the other part of the story was both of these guys were in their 50s. They're happy. They get full benefits. They're getting paid a good salary, so it's not like they was underpaid or, I bought it. Due diligence questions are critical. I mean, I was used to buying oil companies. We bought a property management company, and it was a pretty big company, and we made some critical errors. I mean, I'm used to kicking tires and looking at bulk plants, I didn't think to ask what the age of all the computers in the office was. I didn't think to ask what the age, any problems with the phone system, and a critical there's 25 employees. Guess what happened the day after we bought it, or the week after?
Ice came and got them.
No, but everybody had their hand out. They hadn't had a raise in 5 years. So, and the software system they was using was state of the art, but the owner never paid anybody to get trained on it. So I've done this, but I ain't perfect, trust me. So back to which one do we want to buy? Opportunity one, 60% of business comes from one customer. Opportunity number two, 2 of the 5 techs, remember this is a diesel repair shop, 2 of the 5 techs are 60 years of age and don't want to take any new type of new training. And opportunity number 3, 100% of the lubricants have to come from mobile, and a contract has to pat that contract. Actually, I was doing this while we was going over this valuation. I didn't type the whole thing in there. There's a 7-year contract on the lubricants, and that 7-year contract that you have to buy 100% of your lubes from mobile has to go with the sale of the company. So all the 3 of these really kind of have some hair on it. So, and that's where I talk about it in the book under mean attorneys. But you know, buying a business, you got to make some business decisions, because Dave's going to be all over you that, no, this is a problem. I'm joking. I don't know if he will or not. Some would. I mean, so you get the right attorney. Get an attorney.
People need that.
They do need it.
It's like, it all boils down to the phrase, no amount of paper makes a bad deal good.
Yes. So
If there's problems in it, I can't make it better with a piece of paper.
yes. And I agree with that 110%. But the other thing I would tell you is you still have to make a business decision. Am I going to do this or am I not? Your attorney's job is to make you aware. It's like, there's a problem here, you know. Can you mitigate it? Maybe you're kind of like in my situation where I've got plenty of employees. I don't care. I hope his drivers do want to retire because I already got drivers, you know. Every scenario is different. Strategic, financial. Are you a first-time buyer? Do you have an existing business? Is this an add-on? All kinds of questions. The last one, and this is a good one, especially from a banking perspective, the valuation teeter-totter. So when you buy a company, think of it as you're writing 2 checks. You're writing one check for the value of the company, but you're writing another check, so to speak, for the working capital. So if you have a first-time buyer, we're negotiating the price of this company at $950,000, and he's scraping together every penny that he can get to get that loan from you and meet the debt service coverage ratio. But now you find out it's got $100,000 in inventory and a $400,000 accounts receivable. What's he going to have to do? He's probably going to have to get a line of credit. So how are you going to treat a line of credit?
Margin it.
Yeah. So he's going to probably say, if I give you a $500,000 line of credit and I got to come up with this debt service coverage ratio, I'm going to assume you're going to say, since I'm giving you access to the money, I'm going to say, when I'm figuring my debt service coverage ratio, that you're going to max that sucker out. And I want to make sure if I put those interest payments in your debt payments, there's enough cash flow there to maintain that debt service coverage ratio, right? I mean, every bank will do it a little bit different, but that, in essence, is a scenario. So, what's that going to do to the value that I might be able to pay for the company? It's going to make it go down. So that's the valuation teeter-totter. If you have a company that has great cash flow, and you know, that's where we're going to play this little game here in a little bit. You know, your accounts receivable days are 15, and your accounts payable days are 30. So that means you're holding on to your money for 15 days before you got to get rid of it. In my situation, geez, talk about a mess. That's what I love about C-stores. Guess what happens when you go to a C-store and put gas in your car? You pay for it before you leave. And it's a federal law that if you don't, you could go to jail. In the wholesale fuel, it's messed up. You got to pay for fuel in 10 days. My average AR was 27. My average accounts payable was 12. So it's a 15-day gap. So if you have $100,000 a day in sales, you know, that's $1.5 million you got to be able to fund. I peaked out at $250,000 a day in sales. So even at 200, now that's $3 million that you have to fund. So, you know, I had about $1 million in inventory and over $3 million in accounts receivable. So whoever bought my company wrote a pretty big check because they're going to have to absorb that. you know, and it could have a downward effect on the business versus if you're a cash flow monster, you know, you may be sitting on a couple $100,000 in cash before you got to pay a bill. Does that make sense, you guys? So in this opportunity, opportunity number one, factors 100% of the receivables. So you guys all know what factoring is. Dave, you know what factoring is? So factoring is you're basically selling your accounts receivable and somebody else is buying it. But it's kind of like a credit card. In this case, I said that's high, but the factoring fee is 5%.
Now, is that 5%, is that on a 30-day, or what is the 5%?
Yeah, that's a good question. So
that-
typically the 5% is on the total sale, and then you're going to get your money in a couple of days. Most factoring companies have that. If that customer hasn't paid a factoring company in 90 to 120 days, it's going to get charged back to you. So that can come bite you in the butt.
A friend of mine who does factoring says, oh, I only charge 3%. I said, yeah, but that's for 30 days. So that's like 36% a year. You know, it's, if somebody's, you know, if they go into the 60 days, then it's another 3%, another 3%. And
It's not the, it's, you see, I see a lot of people do it. I say it's like, well, this might be a bad analogy, but it's kind of like cocaine. Once they get started on it, they want to keep doing it, and it's something that eventually they need to probably going to make sense to be weaned off of it.
on a
And
seasonal business, it could make a lot of sense.
yeah,
You know, because if the money's coming in
there
3 months out of the year or whatever.
there's scenarios where it makes sense, but it's factoring is typically done by people who don't have the working capital sufficient enough to support their accounts receivable, or maybe they're not bankable enough to go to somebody like Jason and get a line of credit. Is that fair? So your opportunity number two, average accounts receivable is 60, 90 days and they don't factor it. Now, what could be a problem with that?
That's a long time you're waiting for your money.
It's slow, and because I've run into these situations, what if I require my customers to pay in 30 days?
Yeah, all of a sudden you're gonna
Yeah.
the culture of I'm used to.
Yes, that's exactly what happens. Believe me, I've seen this 1,000 times, and it just makes you jump up and down raving mad. You buy a company, I make them pay in 30 days. They're used to paying 60 to 90 days because there was a big account, and, you know, and maybe it was the previous guy's one of his biggest accounts, and he didn't want to lose it. So they come to me and I say, you're paying in 30 days or you're out. Guess what? They're out. Guess what they do? They go to the competitor, guess when they pay their bill? In 30 days. So you lose the business and they still go to somebody else and they gotta comply. So frustrating. Number three, factor slow pay customers. Other customers pay cash when they pick up the vehicle. Some factoring companies won't let you do that. They'll say you have to factor 100% or we're not going to factor any. Some will let you factor just certain customers. So that is the value builder system and the non-financial things that can affect the value of the company. So which company you want to buy? Did you see some, given our scenario, did you see some strategic opportunities to buy one company over another? Maggie, you got an idea?
Free as an
I was
owner
gonna
pulling
say,
out a
I've got
ton
one.
of money doing nothing, so right there's I'm gonna recast that number at the bottom real quick.
Yeah.
I mean, I haven't made it, that's at least one.
So, the bottom line is there's really no right or wrong answer. It's just what fits. And it's not one shoe fits all, right? So these are just great questions though, that if you're a business owner or if you're thinking of selling your business, of some questions to ask, because I'm telling you, this is real stuff. And you see it all the time. We're listing a company right now. They sell used trailers, so tractor trailers, used trailers. They sell new trailers. They sell a lot of used trucks. And he does all the leasing himself. He funds the leasing. And I suspect this company will sell for north of $6 million. My biggest concern is the owner does all the buying. And he's very involved. Now, he's done some things over the years where he's got some other people that do the selling, and he's got an office manager that's crucial to the operation, but she's one person, so there might be, a golden handcuff. You call that, so to tie an employee down, and you call that golden handcuffs. I don't know how he's got her tied down. It's in a very rural job. He says that it's in a very rural areas, and she needs the job, so a lot of times that'll keep them. But that's a concern even for a bigger company. So,
You're talking about selling the company. Do you also assist in finding the buyer? I mean, there might be a buyer out there who wants that kind of situation.
yeah, that's part of our job, is to help them find buyers. So, on occasion, we definitely represent more sellers, and we try and find the buyers. On occasion, we'll represent a buyer looking for a company to sell. What gets difficult in that, and I mean, some of you guys may see this. What's really difficult for me when I get somebody that comes to me that wants to buy a business, and they're working in corporate America, and they're like, I want to buy a business. I'm like, all right, what kind of business you want to buy? I don't know, something that's got great cash flow, recurring income, and make me, a $200,000 salary, and and revenues are continuing to grow. Well, so does you and everybody else. That's a time. What it is it's a time killer, because you take on a client like that and you give them an opportunity. It's like, hey, Alan, look at this. What do you think of this? Opportunity number one. And you're like, nah, they're going to find something wrong with it. And you bring them opportunity number two. Where we can be beneficial in a scenario like that is, you guys are going to get sick of hearing me talk about oil companies, but say I'm an oil company and I want to buy another operation just like mine in another town or something like that. So if it's an add-on and you want me to go look for a specific type of company, I can search that NAICS code and really do a much more meaningful job of helping you out. So I told you about the Value Builder assessment. You can go to our website. There's a flyer up there that does it. You can take this. It's about 20, I don't know how many questions, but it creates about a 27-page report. And I'd be happy to go over that with you. We usually charge between $500 and $600 for it, but be happy to sit down with you. There is a pre-score I told you about. That's for the owner. And then the other one, we're a member of Biz Equity. And you can send a client there. And if they know these questions, it'll kind of give them a market approach valuation of their business. I have real mixed opinions on that, because most owners don't know how to come up with seller's discretionary earnings, or they don't understand depreciation or normalizing the financial statements. But the reason we put out on our website, because I feel most of the time people are going to take it, get about halfway through it, and go, why don't you just help me with this? So we'll talk about the book for a little bit. The name of the book is You Don't Know What You Don't Know. It's a book about mergers and acquisitions. So we start off talking about why you might want to buy an existing business versus starting a business from scratch. And then I kind of get into a way to value a business. The middle part of the book, I say, is about building your team. So there's chapters on attorneys, CPAs, bankers. We just about cut them all. Bankers, financial advisors. Who am I missing? Bankers, attorneys, CPAs, financial advisors. There's
Marketing people too.
Yeah, I agree with you. It's a good part of the team. I don't have a chapter on it. I do have a chapter on your bankability and debt service coverage and global debt service coverage, stuff like that. Then there's a chapter on building value in the book, which is kind of funny because I wrote that before we joined the Value Builder system, but it's really, how to build value in the company. And then it gets into selling the company in the mind game that is. And then the last chapter I called Don't Be Like the Dog That Caught the Car. Have a plan with what the heck you're going to do with your life once you sell. It's an issue, trust me. Especially if you're 40. It's like my wife told me, she's like, I know one thing, you ain't hanging around the house. You're going to get a job. Get out of here. So I jokingly say my house is a marital asset that I'm not allowed to be at during the day. So it's an easy read. So we prefer to work with clients that have a value between 1 and 15 million. So we don't like to do Main Street deals. the reason we like that range is because I feel that if you're going to sell a company that's worth $5 or $6 million, you need somebody with some business acumen to help you through the deal. And those are still traditionally regular bank loans. You're not really dealing with private equity companies. Once you get above 15 million, it kind of gets to be a different ball game. So, all right. Before we move on to the next thing, any questions? All right. So, we've spent a lot of time, I'm going to get this out of your hair, talking about cash flow and getting that cash flow to the bottom line. When we do coaching, I like to coach my business clients on putting their income in an income trend and really watching those trends. And I do that with their income statement and their balance sheet. And I prefer that they manually input the numbers so they see them in their head. And then the next thing we do is we create a ratio analysis page where if I can teach you, 8 or 10 things to keep an eye on, then I feel like you can have a pretty good handle on how your company's ticking. And you guys can probably preach to it that it is amazing to me how many business owners and even owners of large companies have no idea about their financial statements. I valued this manufacturing company, classic thing, dad's in his 70s, still owns all the stock, 3 siblings in the business. One shouldn't be in the business because he doesn't do anything, collects a paycheck. The daughter's a CPA and does all the financial statements. So, her financial statements are all done in Excel and they're huge. Geez, it took me like 3 hours to analyze what in the world she had all going on and utilization rates for the manufacturing and just, whew. Dad is not a finance guy. And I'm presenting the valuation and he literally slams his hand on the desk and he says, "You've mentioned financial statements twice. I'm going to tell you this business is not going to be sold on its financial statements. It's going to be sold on the products that we manufacture." And I'm sitting on the other side of the table going, oh boy. He didn't get it. And his daughter's financial statements were so complicated. My eyes about glossed over looking at them. So one of the things that I'm big on is accounts receivable days, inventory days, payable days, keep track of your current ratio. That's a cush, right? Now they can absorb some expenses.
Quick ratio versus.
Yeah, our quick ratio, current ratio, debt service coverage ratio, are you bankable? What's your global debt service coverage ratio? It's funny, one of my coaching clients, when I first started with them, I get their financial statements, when we started helping them, it's like their current ratio was 1-to-1. So that means your current assets, cash, accounts receivable, stuff that you're going to get disposed of pretty quick, was the same as their accounts payable. So they had as many quick payables as it did quick receivables. What's that classic sign? They're short of cash, right? They're kind of sweating the checkbook. And we'll get into this about 6 months. And this is all we fired their bookkeeper and hired them a CPA and cleaned it up, income statements, 8 pages long. It's not a readable document. And we started doing this, and it might have even been closer to a year. And I started explaining this current ratio, and she's like, that's why the very first time we met, you knew that we were short of cash. And I'm like, yeah. She goes, we went home that night, I told my husband, he's like, how does he know that we don't got very much money in the checkbook? That's why. So I developed this game. I'd like for a couple of you to help me with it. How this started is I have another coaching client in Washington State, and I'm trying, same thing. We've developed the ratios and I'm trying to explain it. The wife is getting it. The husband is sitting looking at the screen. We do a Zoom conference with them. And finally she reaches in, she's like, look, Alan. She reaches in the desk, grabs a whole pile of paper clips, throws it on the desk and says, look, if you do this, and then all of a sudden he goes, I get it. It was visual. She looks at me in the camera and she goes, he's a visual person. You got to show him. So I have a scenario. I would like, if somebody can be my revenue person and somebody be my checkbook person. Maggie, you want to help? Or Alan, you want to help?
I was going to say.
Okay.
See my chart there.
So in this scenario, first we're going to say your, what's the best way?
Just turn the table for me.
Okay. It might help you guys too. Got it? All right. There you go. Just, yeah, we can turn that one there. Okay, the first scenario, we're going to keep it simple. Alan, can you see? Can you see?
Yeah.
Okay.
Don't look at me again.
Huh?
I'm going to keep it simple on your.
Okay. We're selling, our accounts receivable days are 8. And our accounts payable days are 3. So we're just selling 1 ball a day. So on day number 1, I got a little check mark here, otherwise I lose track. So on day number 1, you sell a ball. So what are you going to do? This is your revenue bucket, green balls, right? All the revenue in the world. This is your line of credit, the red balls, and you only get 10 red balls for your line of credit. Okay? So we'll kind of balance that right there. So on day number 1, you sell something, and where does it go?
Accounts receivable.
It goes into accounts receivable, right? So day number 2, you sell something, got another ball in the accounts receivable, right? Okay, day number 3, you sell something. Now, we have a payable, we got a bill to pay, right? Dave, what are you gonna do? You ain't got no cash in the checkbook.
Put it in the checkbook.
Yeah, so he's got to use from his line of credit, right? Day number 4, you're gonna sell something. You've got another bill to pay. Oh yeah, so we're gonna bypass the checkbook.
Okay, yeah, it's gotta come out of there.
Come on, Dave, play the game right, will you?
I was just gonna go there and then go there.
So day number 5, again, you sell something.
Got another bill?
Yep, you gotta pay another bill. Goes from there to there. Day number 6. Kind of get to routine now. Got day number 7. Then number 8. Now.
We're running short over here.
Uh-huh.
8 when one of these goes.
Yes, there you go. So now we finally got some cash, right? So now it's day number 9. There.
Should go.
Yeah, so do you want to keep some cash in the checkbook, or you want to use some more money off your line of credit? So you got a choice.
I probably have 4, so I'm probably going to go here at least.
Okay.
Maybe today.
And then day number 10.
I think I'll go there.
Okay. So what have we created right here? This is the working capital that's needed to run this situation. Does that make sense? Joy, you nodding? You're quiet. Jason, does that make sense? So you guys get it? Does that make sense for you, Alan?
Yeah.
Okay. Now let's
It's your money change.
Yeah, it's your money change. So I mean, if it changes, yeah, that's what can get hairy. So let's go back to square one. Now we're going to say you have 3 accounts receivable days and 8 accounts payable days. So we flipped it, right? Okay, so day number 1. Okay, day number 2. Day number 3. Okay, what happens on day number 3?
Goes in the checkbook.
Aha. Day number 4.
And wouldn't.
So, okay, you're kind of cheating here, Maggie. We got to make sure we go through the bucket. He didn't pay it till the end of the day. We got to wait for the credit card to come back. Day number 5. There you go. Day number 6. Day number 7. And now day number 8. So the whole theory is, in this scenario where your receivable days are less than your payable days, you're creating positive cash flow. Now and so again, you can get people confused. You know, positive cash flow, yes, that means you have a profitable company. But how the money flows around inside of your company is very, very important. And I mean, I could write you several scenarios where you can have a company go broke, not because they wasn't profitable, but because they ran out of cash. Yeah. So trust me, when fuel is $4 a gallon, and I mean, so one scenario, just so you guys know, I don't know have you guys ever heard of a borrowing base certificate? Joy, have you heard of a borrowing base certificate? Okay, so a traditional line of credit, I come to you and you give me a $500,000 line of credit, right? If I need to go to $700,000, what do I got to do?
Provide the assets,
Do what?
have the assets.
Yeah, but basically I got to come back to you and we got to renegotiate this deal, right? Okay. Well, I started out on a traditional line of credit. And as I'm growing my company, and for 8 years, sometimes we grew by 100%. I am blowing through my line of credit because my volume's going up and the price of fuel is going up. So my working capital needs are increasing. So if we'd have done this with 8 balls, you know, we didn't need a bigger line of credit, right? So what a borrowing-based certificate does is it basically, in a nutshell, says there's no top to your line of credit. Sorry, Ted's been keeping. There's actually no upper limit. So then the bank says, I'm going to lend you 75 to 80% of your accounts receivable that's less than 60 or 90 days, and I'll lend you 50% of your inventory that's good inventory. So at the end of the month, then you provide a borrowing-based certificate that says, you know, my accounts receivable was $1 million of under 60 days, so I'm going to loan you $800,000. My inventory was $1 million. That was good inventory, so I'm going to loan you $500,000. So that's $1.3 million. So as long as I don't have over $1.3 million pulled on my line of credit, I didn't buy any extra trucks or things that I wasn't supposed to use it for, you're in good shape. But that way, as things go up and down, and once I got on a borrowing-based certificate, we was good to go. So we're going to do another scenario here, but a funny story. This guy is still a banker. It's Steve Smith with Town and Country Bank. He worked with me while I was going through this phase. And one day, he loves to tell this story, I was overdrawn by like $700,000. And the president, the CEO of Associated Bank in Green Bay, Wisconsin, calls him. He's like, do you know Terry Lammers? Yep. Do you understand his company? Yep. Are we good? Yep. Okay. But, you know, because of my working capital requirements, I was very tied to my banking relationship, you know, and it's a nerve-wracking deal. So, okay, let's change it around a little bit. Now we're going to say you have 3, how did I do this? We have, you have 8 accounts receivable days,
Okay.
and we have 3 accounts payable days. Yes. No. I'm going to do this the other way around.
First, yeah.
Let's do this. First, we're going to start off with, we're going to sell 3 balls at a time.
Okay.
And your accounts receivable days are 3, and your accounts payable days are 8. Okay?
Okay.
So the first day, you put 3 balls in there, right?
Yep.
And the second day, 3 more balls. And the third day, you sell 3 more.
This is
And
changing.
3 go into there. Okay, now stop. Now, we've decided we want to grow the business. So we've hired a salesman. And he goes out on the road and he's picking up customers. But he's picking up slow paying customers. So now, you're selling 5 balls a day, and you flip-flopped. Your accounts receivable days are 8, and your accounts payable days are 3.
Okay.
Okay, so day 1, so 5 balls.
5,
Day 2,
4, 5,
day 3,
4, 5.
yeah,
How many days?
you're gonna take 5 out. Yeah, okay, now day 4, you sold 5. You're gonna use a combination of either what's in the checkbook or your line of credit. Day 5, day 6, you sold another 5.
Can't do it.
You're out of cash. So the first time I did this, the guy's name was Joe. I go, Joe, what are you gonna do? You don't have no more line of credit, and the checkbook is empty. And he's looking at me and he goes, I'm gonna be nicer to my wife. So, but no, so that's a real scenario. So you get it? I mean, it could be a profitable company, but they ran out of cash.
Selling yourself into insolvency.
You
Yes.
still have checks in the checkbook.
Yeah, right. Right? So, thanks guys. But that's a real situation. I mean, trust me, I lived it. And you see it all the time, especially with small businesses or I mean, it's just difficult. You know, once your company gets to a certain size, at least in our great state of Illinois, we had to have estimated sales tax. So you basically, you know, the state says just keep enough money in this account and you estimate your weekly sales and we'll take that out. You know, now all of a sudden you start making money and the mean CPA tax advisor tells you, oh, your tax bill for this year because you made money was $30,000. Oh, and by the way, you need to start paying estimated taxes, right? So now not only do you have to scratch and come up with the 30 grand, you're supposed to come up with your first quarter estimated taxes, and it can put people in a spiel. I was working with a guy the other day, and he especially works with smaller trucking companies. You know, that's an issue. You know, you got to pay the mean fuel guy in 10 days, but you're working with state, and maybe you only get paid in 90 days. You know, so it's an issue.
Mary, you mentioned your relationship with your banker, right, when you were running the oil company?
Mm-hmm.
And in that instance right there, you know, that relationship is really key, because if you catch it, you got the right people surrounded and you're looking at the right measurables, metrics on your financials, you can head that problem off
Yes.
before it drowns you.
Yes. So what Jason's telling you is have a relationship with your banker. Regions had a deal, know your bank or know your client, right? So the banker should know his client. But it's just, I think there's just as much responsibility on you as the business owner. There's still a reason for you to go into that branch and meet the guy that's going to be loaning you the money. I would have a meeting, I mean often, but specifically at the beginning of each year, we would go out to lunch. You know, and I would tell them, look, I'm looking at buying this company. I'm looking at buying this truck. You know, what bank ratios are you looking at? You know, where do you see my borrowing capacity? You know, is there any red flags that the bank is looking at? Now, Jason doesn't want to hear this, but I also split my banking relationship. And I had one bank do the real estate and one bank do my line of credit and stuff like that. So I had a relationship with two banks. And then I was working with two banks, but I also went out and talked to a third bank who I would give my financials and stuff to. Didn't really do any business with them, but they knew my situation. So if I had a hiccup with one of the other two, I had somebody that was already familiar with my company, you know, my personal finances and stuff like that. So very key stuff. And that's why it's all about building your team. So it's 3 o'clock. We got till 3:30. I was going to run through this business valuation, an actual valuation that we did on a company, and show you. Does anybody need a water or anything? We good? Any questions? Here we go. This is what we want. So I don't have this on a PowerPoint presentation, but this was an actual auto body shop. And he was looking, the scenario is, he's looking at purchasing another business. Another auto body shop in a town that's about 20 miles from him, okay? So, ended up valuing this company for $1.6 million. This is just the beginning of one of our valuations. Here's that revenue ruling 5960, remember? Basically, Dave was, I don't know if he was in here or not, but IRS revenue, you familiar with it? Basically, it means your company's worth what you're willing to sell it for and what somebody else is willing to buy it, in a nutshell. We talked about the 3 approaches, right? And we get to the income trend here. I don't know why it won't let me make this bigger again. But anyway.
It's on the top. It's in the middle on the top.
The plus with the circle around it.
Yes.
Oh, there we go.
Right pane by clicking that gray arrow on the vertical on the right side.
Can you see that a little bit better?
You can get rid of that toolbar on the right too.
How you do that?
That little
There's an arrow middle way down on that gray bar.
Arrow on the gray.
over to my, oh, there we go.
There, right here.
Yeah, look at that.
Oh, God knows, takes us up down there.
All right, so you can see pretty top line revenue, 3.6, 3.8, 4 million, you know, so pretty, can you see that, Alan? Pretty normal. Again, I'm not about sales and net income, I'm about gross profit and cash flow. But if you look at his gross profit, pretty steady. No big surprises here, about 1.8 million in gross profit. All of his expenses. The key part of this, so here's a good one to talk about rent. If you put a fair market rent in, so the question is, what do you do with real estate? I told you about the equipment, right? You buy the equipment to create cash flow, and you're valuing that cash flow. Real estate always muddies the waters in evaluation, but really the easiest way to handle it is to make sure they're paying a fair market rent. So if you know the value of the building, if you're buying commercial, if I own commercial real estate and I want to have renters, it's pretty common to have an 8 to 10% cap rate. So we had that 32, 10%. You're only getting a 10% return on your investment, or an 8%. But if you put a rent in there at an 8% cap rate, if you go to Jason to borrow the money to buy that building, that on a 20 to 25 year amort, that should cover the payments for that building, okay? So it's important when you're doing evaluation to look at, is the guy paying himself rent? It's assuming that he owns the building in another entity. You know, is he paying himself a fair amount of rent? The valuation we went over this morning, he was only paying himself, say like $90,000 a year in rent, and a fair market rent was $144,000. So we added back what he was paying himself, but then we took out the fair market rent, which in turn really lowered his EBITDA number. Likewise, if you're buying a business and the owner wants to keep his real estate, you buy the business and you pay him rent, because now he's got ongoing cash flow, right? What does he want to charge you for rent? If he wants to charge you $48,000 a year for rent, then that's going to lower the value of the business because it's lowering the EBITDA. If he is willing to take to 24, now you got more cash going to the bottom line, the company's worth more. Does that make sense? Alan?
Yeah, I was just,
This,
most of these people that buy in our business, they want to rent.
rent the property?
Yeah.
But so the rent is a very valuable thing. So here's other income. So the main thing you want to get to in these situations is the add backs. So here's the compensation to the officers. You know, he's paying himself in the last 2 years $193,000 a year. The depreciation expense. I thought this was a valuation. I did something a little bit different, but so you got, 3 years. So the next big thing when you get to this point is what are you going to use to value this company? Here's your trend. Is the trend going up? Is the trend coming down? Is it flat? A lot of times when, don't do this, you have an owner that's getting close to retirement. He does what I call the glider path. So this year was 670, then it was 600, then it was 550, then it was 500. So he's just drifting down like this. The company was worth a lot more back here, but this is where he quit, and he's been going downhill. Is it a new company, and you're going up like that? I told you there's different methods. There's a method called the discounted futures cash flow. So maybe you're valuing the future cash flow of the company because it's going like this, or are we just going to use an average? So in this particular valuation, I used a 3-year average, and comes out to 598. I have another valuation that I did in where we talked about the hub and spoke. So we added back in, we'll take out a fair market salary, but in that case, the owner did all the work. So we took out 80 grand a year for 2 techs that he was going to have to hire in order to make this valuation work, or to make this company work for him. So $100,000 salary, 20% down, leaves you with a loan of $1.2 million, $1,280,000 at 6%, 5-year amortization schedule. Here's our average seller's discretionary earnings fair market value. So that's our EBITDA. That's what we're valuing. In this scenario, you have debt service coverage of $296,000, and it's leaving you with a debt service coverage ratio of 1.68. So that works, right, Jason? Another scenario where I ran it at $1 million and ended up with a debt service coverage ratio of 2.68. And there's probably a third one. We ran it at 2.4 million and ended up with a debt service coverage ratio of 1.12. So 2 million is too high, million field 1.6 makes sense. This is a comparable, I don't know, we won't work. This is actually employment data that I used in the valuation. This is the rule of thumb data. So this is from a company called Business Reference Guide that publishes this rule of thumb data. This is a NAICS code for auto parts and accessories, retail stores. It's the closest one I could find for auto body. But the rule of thumb data says annual sales plus inventory of 40%. Then there's just some other valuable data in here that they give you. This is some comparables also. 2.66 times seller's discretionary earnings. So I give a summary. So our bankability measure, it comes out to 1.6 million. 17 and 18 sales were 4 million. SDE of just about 600,000, EBITDA of 500, inventory of 785. It's got a huge amount of inventory for some reason. So this scenario in the market value data of 40% of annual sales plus inventory, you can see we come up with a value of 2.4, but we ran a bankability method on it and it don't work, right? So the next way that we found some market comparables was 1.3 to 2.75 seller's discretionary earnings give us a range of 784 to 1.6, so that's in the ballpark. And then 3 to 4 times EBITDA, 1.4 to 1.9, so we fall in the ballpark of that also. So that kind of gives you an idea of some market data. What we'll do for a lot of clients is put on there, if this is an asset purchase, what am I going to get from the sale of this company? So the real estate was worth $350,000. The sale of the business is going to get you 1.6. Typically you're going to keep your cash, collect your accounts receivable, and somebody's going to pay you what your inventory is worth at cost. So cash of 81, accounts receivable 355, inventory 785. So he's looking at getting this net of taxes at about 3.1 million. But now is where you bring in another important part of your team, right? Who's your tax advisor? Who's your attorney? It's not about what you're going to sell the company for. It's about what are you going to keep net of taxes. Right, Dave?
Opportunity cost.
Yes. So that's a big number. Kind of a story for another day, but the first page of my book is about the allocation of assets of a company, that Thomas Oil company that I wanted to buy. Ironically, we both used the same attorney. I had to have the allocation of the assets, how we put the price tag of the company on the assets a certain way, or my evil banker wasn't going to lend me the money to buy it. However, by doing it the way I wanted to do it, it was going to cost the seller, because I was putting more money on the value of the assets, which he already depreciated off, which means it's going to be ordinary income and it's going to be taxed at a higher rate than if it was goodwill. So it was going to cost the seller over $100,000 more in taxes, and naturally his CPA was fighting for it. So the first page of the book talks about, that little battle that went on literally days before closing on the deal to go through the allocation of the assets. So there's a whole nother story and presentation of how do we get you as much money as possible once we determine the value of it.
That's actually the most negotiated aspect.
It is. It really is.
What's the basis and value if you allocate it among the assets, because it is.
So, yeah.
As a buyer, I want to be able to set up basis that I can amortize.
And
As a seller,
I don't want to pay
big tax.
I don't want to pay taxes. Lost my train of thought. It is, so you go back to the IRS thing and the auditing, right? That's where I was going with this. So when Growmark wanted to come to me, we said, all right, we decided on what the purchase price is going to be, but what about this whole allocation of assets? You know, how are we going to do that? She said, you can do whatever you want. It's like, okay, I'll sell you all my assets for $1 and we rent the rest on goodwill. She's like, good luck getting that past the IRS. So, you know, so it has to be some sort of reasonability in there to pass the IRS sniff test. But at the same time, that can be the bigger the deal gets, the bigger that window gets. You know, most biz owners, when they sell, what are they worried about? They're worried about getting that check, right? I want that big check. But that big check comes with a lot of tax liability. So, build your team. I mean, if I had to leave you with one thing, build your team. You need the right people on your team to get you through the process.
Well, and some of that can end up being ordinary if you've got recapture and things like that.
Yeah,
You want to get as much in the capital column as you can.
yeah. It really does get complicated. So, like I said, build your team. So, that's about all I got. Any other questions, or I'll let you loose. Thanks for coming. Appreciate it. Nice that you jumped right off a plane. So, so thanks, guys.
Thank you, Terry.